In every major housing correction cycle in American history, the markets that produced the most financial damage were not the ones that looked risky. They were the ones that looked safe. The ones where prices had been stable long enough that stability had become the assumed permanent condition rather than a temporary market state. The ones where inventory was low enough that the idea of a buyer's market felt abstract and distant. The ones where the local employment picture looked solid enough that the concept of demand risk had stopped entering the conversation entirely. This is the defining characteristic of the late-stage market illusion. Stability becomes the narrative. And while stability is the narrative, the structural forces that will eventually disrupt it accumulate in data that nobody is examining because the surface indicators give no reason to look deeper. That assumption that a stable market is a safe market? It is the most expensive analytical error in real estate. The previous cycle produced exactly this dynamic. In 2006 and 2007, the markets that generated the most severe homeowner financial damage in the subsequent correction were not the markets that everyone was already worried about. They were the markets in the middle of the country, the Midwest suburbs, the southeastern secondary cities, the interior Sun Belt communities, that had looked stable and reasonable and fundamentally sound while the credit and construction excesses that would eventually unwind them were building quietly in the background. In the current cycle, that same pattern is operating in specific U.S. markets. Markets that are currently being positioned as safe alternatives to the already corrected coastal cities and Sun Belt metros that have been generating the most coverage. Markets where the stability signal is real on the surface and structurally fragile underneath. Markets where the homeowners and investors who are relying on that surface stability to make financial decisions are operating without the information that the deeper data would provide. This breakdown identifies those markets, explains exactly what the structural data is showing that the surface indicators are not, and provides the analytical framework that separates genuinely safe markets from ones that merely appear safe in the current cycle. The specific mechanism. There is a specific mechanism operating in the markets we are about to identify that makes their apparent safety misleading in a way that is different from the obvious oversupply and rate sensitivity risks that have already been widely analyzed. I will name it precisely as we work through each market category. But I want to plant something in your mind now. The markets that look safest in the current cycle are often the ones where the lock-in effect is operating most powerfully, and the lock-in effect has a consequence for market safety that almost nobody in the mainstream conversation is connecting correctly. Hold that thread. The anatomy of a safe-looking market that is not. Before identifying the specific markets, the analytical framework matters. What specific combination of surface indicators creates the safe appearance while structural risk builds underneath? Understanding this mechanism makes it possible to evaluate any market, not just the ones named in this breakdown, against the correct set of questions. The safe-looking market in the current cycle has a characteristic profile. Prices are flat to modestly appreciating rather than dramatically rising or falling. Inventory is low by historical standards, creating the impression of supply-demand balance that historically correlates with price stability. Days on market are elevated from their pandemic-era lows but not alarming by pre-pandemic standards. And the local employment picture, while not booming, shows no obvious sign of the kind of acute stress that has historically preceded rapid price deterioration. Here is something most people completely overlook. Every one of those surface indicators can be simultaneously true and misleading. Low inventory can reflect lock-in trap dynamics rather than genuine demand strength. Flat prices can reflect transaction volume collapse rather than market balance. Stable employment can mask income-to-price ratio stress that is building toward an affordability wall rather than retreating from one. The surface tells you what has happened. The structural indicators tell you what is building. In the current cycle, the gap between those two readings is wider than it has been at any point since the previous correction. The first structural indicator that the surface stability narrative consistently misses is transaction velocity. A market where prices are flat but transaction volume has declined significantly from its historical norm is not a stable market. It is a frozen market. And frozen markets do not stay frozen indefinitely. They either thaw gradually as rate and affordability conditions improve, or they crack suddenly when a trigger event, a local employment shock, a rate spike, a forced seller wave, removes the artificial floor that the lock-in dynamics have been providing. The second structural indicator is the income replacement trajectory. When a local market's primary employer base is in a sector undergoing structural transition, the current employment stability can be a lagging indicator of forward demand weakness. Workers who are currently employed in a transitioning sector are not yet generating the demand reduction that their sector's long-term trajectory implies. But they are making housing decisions today based on income security assumptions that the sector's forward trajectory does not support. Markets where the employment base is concentrated. In sectors facing structural disruption, legacy retail, traditional office, manufacturing segments facing automation pressure, carry demand risk that their current employment stability data does not capture. Pause. The employment data tells you where incomes are. It does not tell you where they are going. The third structural indicator is the insurance and carrying cost trajectory. In markets that have been spared the most dramatic insurance repricing that has affected coastal Florida and fire-prone California, a slower but real increase in insurance costs, property taxes, and HOA fees is quietly compressing the affordability of ownership in ways that are not captured in the median price data that most market analyses rely on. A market where median home prices are flat but monthly carrying costs have risen significantly due to insurance and tax increases is a market where real affordability has deteriorated without that deterioration appearing in the headline number that homeowners are using to assess their equity position. The three structural indicators paint a picture of how the safe-looking market illusion is constructed. Now the critical question is which specific market categories in the United States are most deeply caught in this illusion right now. And this is where most investors get caught because the answer is not the markets anyone expects. Category 1. The Midwest Suburban Stability Trap. The Midwest suburban markets that have been positioned as the rational alternative to overheated coastal and Sun Belt markets represent the largest and most consequential category of safe-looking markets that carry structural risk in the current cycle. Cities like Columbus, Indianapolis, Kansas City, and their surrounding suburban belts entered the national conversation as the smart money destinations during the peak of the Sun Belt correction narrative. The logic was straightforward. These markets never overbuilt. They never attracted the speculative capital that created the Phoenix and Austin oversupply situations. Their prices are grounded in local income fundamentals. They are the responsible markets. This is what I was referring to earlier when I said the lock-in effect has a consequence for market safety that almost nobody is connecting correctly. In Midwest suburban markets, the lock-in effect is operating with particular intensity because the appreciation during the pandemic era, while more modest than Sun Belt markets in percentage terms, was still substantial enough in absolute dollar terms to create a meaningful financial penalty for homeowners who need to sell and repurchase in the current rate environment. The result is a market where transaction volume has declined sharply from its pandemic-era peak while prices have remained nominally stable. That combination looks like balance. It is actually frozen demand meeting frozen supply, and the stability it produces is fundamentally different from the stability produced by active, liquid markets with genuine price discovery happening continuously. The income replacement trajectory risk in Midwest suburban markets is concentrated in two specific sectors. Traditional corporate office employment, which has been undergoing structural reduction as remote and hybrid work patterns have permanently reduced the square footage and headcount concentration that previously characterized major Midwest corporate campuses, is generating a slow-motion demand reduction in the commuter belt communities that were sized and priced for that employment pattern. The reduction is not dramatic enough in any single quarter to show up as market stress. It is consistent enough across multiple quarters to be accumulating in the leading indicators of the markets most dependent on that employment base. The second sector is traditional retail and distribution employment, which is undergoing the automation-driven restructuring that has been projected for years and is now materializing in the employment data of specific Midwest markets. The workers displaced by this restructuring are not immediately becoming homeless. They are absorbing the income reduction through savings drawdown, family support, and reduced consumption. But they are also making housing decisions, staying in homes they might otherwise have sold, delaying purchases they might otherwise have made, that are keeping the transaction volume low and the apparent market stability intact while the underlying demand is quietly eroding. Here is what nobody tells you. A market can look perfectly stable while its demand base quietly deteriorates. The lag between the deterioration and the price signal can be measured in years. The carrying cost trajectory in Midwest suburban markets adds the third structural stress that the surface stability data is not capturing. Property tax rates in many Midwest markets have been rising as municipalities face fiscal pressure from pension obligations, infrastructure maintenance backlogs, and revenue growth that has not kept pace with expenditure growth. The effective property tax burden on a Midwest suburban homeowner has increased meaningfully over the past several years without producing any corresponding increase in median home prices that would signal to the market that carrying costs have risen. The affordability wall is building in the carrying cost structure rather than in the purchase price, which is precisely why it is not showing up in the data that most analysts are watching. The Midwest suburban stability trap is the largest category by geographic scale and by the number of homeowners exposed to it. But the second category represents a more acute and more time-sensitive version of the same dynamic, operating in markets that are currently being actively recommended by major real estate publications as among the best places to buy in the country. Now here is where it gets serious. Category 2. The secondary Sun Belt markets hiding in plain sight. The correction that has been playing out in Austin, Phoenix, Dallas, and Atlanta has generated a narrative that positions the secondary and tertiary Sun Belt markets as the safer alternative. The logic is that these smaller markets did not experience the same degree of speculative overbuilding and do not carry the same oversupply risk. That logic is partially correct and dangerously incomplete. Markets like Huntsville, Alabama, Greenville, South Carolina, Chattanooga, Tennessee, and Boise, Idaho absorbed meaningful pandemic-era migration and appreciation without generating the construction pipeline volumes that created the oversupply problems in the major Sun Belt metros. Their vacancy rates look manageable. Their price declines have been modest. They are being positioned as the corrected but stabilizing markets that offer genuine value relative to their coastal and major Sun Belt alternatives. The structural risk that this positioning obscures is the demand sustainability question. The migration that drove appreciation in these secondary markets was concentrated in two buyer profiles that have both become less active in the current cycle. Remote workers who relocated during peak remote work adoption and who have since seen their geographic flexibility reduced by return-to-office requirements at their employers. And equity flush buyers from California and other high-cost coastal markets who used pandemic-era appreciation in their origin markets to fund cash-heavy purchases in lower-cost destinations. Both of those buyer profiles were providing external capital support to these markets that the local employment base alone could not sustain. Here is the data point that most secondary Sun Belt market analyses are not surfacing. The share of transactions in these markets during the peak migration period that were cash purchases or that involved buyers whose income was generated in a higher-cost origin market is significantly above the historical norm for these markets. That share has been declining as the migration wave normalizes. The buyer pool that is replacing the migrant buyers is the local buyer pool, and the local buyer pool in Huntsville, Greenville, and Chattanooga is constrained by local income levels that are meaningfully below the income levels of the buyers who established current price levels during the migration peak. This is the income replacement trajectory risk operating in its most acute current form. That assumption that local demand will absorb where migrant demand leaves off? The income math does not support it in most of these markets. The specific market that most precisely illustrates this dynamic in the current cycle is Boise, Idaho. Boise experienced one of the most dramatic pandemic-era appreciation events of any American market outside the major coastal cities. The appreciation was driven almost entirely by California and Pacific Northwest migration that brought external capital and higher income expectations into a market whose local employment base had never generated the demand to support those price levels independently. The migration has normalized. The local buyer pool is reasserting itself as the dominant demand source. And the gap between what local incomes can sustain at current mortgage rates and what the pandemic-era appreciation established as the market price level is creating the affordability wall that will either be resolved by price adjustment or by an extended period of transaction volume suppression while local income growth gradually catches up. Neither resolution is quick. Neither is comfortable for current owners who purchased at peak valuations. The market that will surprise everyone. There is one market in this breakdown that will genuinely surprise most viewers who consider themselves well-informed about U.S. housing market risks. It is currently appearing on multiple best markets to buy lists from major real estate publications. It has positive population growth, a diversifying employment base, and price stability that looks like genuine market health rather than frozen market stasis. I will identify it precisely in the final section. Hold that thread because the mechanism that makes it dangerous is the same mechanism that is making it appear safe. Category 3. The Northeast Stability Illusion. The Northeast housing markets that have been least affected by the volatility of the pandemic-era boom and correction cycle are currently carrying a specific form of structural risk that their surface stability is most effectively concealing. Markets across Connecticut, upstate New York, western Massachusetts, and the secondary New Jersey suburbs have maintained price levels and transaction activity that look, relative to the dramatic swings experienced in Sun Belt markets, like models of market stability. And in a narrow sense they are stable. But the stability is being maintained in part by the same lock-in dynamics operating in Midwest suburban markets, and in part by a unique Northeast-specific factor that is adding a layer of forward risk that neither the local market data nor the national narrative is currently capturing. That Northeast-specific factor is the commercial real estate contagion from the office market collapse in the major gateway cities, particularly New York City and Boston. The collapse of office valuations in these markets is generating municipal fiscal pressure that will force tax adjustments affecting residential property owners in the surrounding commuter markets. The mechanism works as follows. When office buildings that were assessed at high values for property tax purposes are revalued to reflect current market conditions, the municipal tax revenue from commercial real estate declines. That revenue decline creates a fiscal gap that municipalities have limited options to address. They can cut services, raise residential property taxes, or some combination of both. In commuter markets whose residential property values and desirability are directly connected to the quality of services that local municipal revenues fund, both outcomes are negative for residential property owners. This is what I was pointing toward earlier when I described the carrying cost trajectory as the third structural indicator that surface stability consistently misses. In Northeast commuter markets, the property tax increase risk is not speculative. It is being driven by a commercial real estate valuation reset that is already underway and whose fiscal consequences for residential property owners are building on a timeline of 1 to 3 years rather than immediately. The homeowners who will be most surprised by the resulting carrying cost increases are the ones who are currently interpreting their market stability as evidence that these risks do not apply to them. The commercial real estate collapse is not staying in the commercial real estate market. It is traveling through the municipal budget into residential property taxes. The Northeast commuter markets also carry the income replacement trajectory risk from the financial services and traditional corporate sectors that have been their primary employment anchors. The restructuring of these sectors, driven by technology adoption, remote work normalization, and the ongoing reduction of office-based support roles that automation has made increasingly redundant, is generating a slow-motion reduction in the high-income employment density that has historically supported the premium valuations of Northeast commuter market housing. The effect is not yet visible in the unemployment data. It is visible in the income distribution data of these communities, which shows a gradual compression of the high-income household share that drives the upper end of the housing market in these communities. 3 market categories, each carrying structural risk that their surface stability is concealing. But the specific market I referenced earlier, the one that will surprise everyone because it is currently appearing on best markets to buy lists while carrying the most acute version of the structural risk we have been analyzing, is where this breakdown reaches its most actionable conclusion. The market that surprises everyone. Nashville. Nashville is currently one of the most positively covered real estate markets in the United States. It has genuine demographic momentum, a diversifying employment base that has moved beyond its music industry identity to include healthcare, technology, and financial services. It has positive net migration. Its price declines from the peak have been modest compared to peer markets. And it has a cultural energy that generates the kind of organic positive narrative that no marketing budget can replicate. It is also carrying the most acute version of the structural risk profile we have identified across all 3 market categories simultaneously. This is what I was building toward from the very beginning of this breakdown. Nashville's surface indicators are as good as any market in the country right now. The structural indicators tell a different story. Transaction volume is significantly below its pandemic-era peak, reflecting lock-in dynamics that are as intense as any Midwest market despite Nashville's stronger underlying demand. The income replacement trajectory is complicated by the fact that a significant share of Nashville's pandemic-era appreciation was driven by the same migrant buyer profile, California and Northeast equity flush cash buyers, that is now less active in secondary Sun Belt markets broadly. And Nashville's construction pipeline, while less severe than Austin or Phoenix, added enough new supply during the boom years to create meaningful absorption challenges in specific market segments that are now competing for a local buyer pool whose income levels do not fully support the price structure that migrant buyers established. The carrying cost trajectory adds the final layer. Nashville's property taxes, while not as severe as the Northeast or Midwest fiscal stress markets, have been rising as the city's infrastructure investment requirements have outpaced revenue growth from the commercial tax base. The combination of rising property taxes, insurance increases, and the fundamental affordability gap between local income levels and pandemic-era price levels is creating a market where the monthly cost of ownership for a buyer entering today at current prices and current rates is substantially above what the local income distribution can broadly sustain. Nashville is not going to collapse. Its genuine demand fundamentals, the healthcare employment anchor, the music industry draw, the physical geography of the Cumberland Valley, provide a floor that markets without these characteristics do not have. But the gap between how safe Nashville looks from the outside and how vulnerable it is to a correction if any of its demand supports weaken is considerably larger than its current positioning in the national real estate conversation acknowledges. What informed capital is doing in these markets right now? The informed response to this analysis is not panic and it is not paralysis. It is a recalibration of the analytical framework from surface indicators to structural indicators, applied to specific positions and specific markets with the discipline that the current cycle demands. The first recalibration is the transaction velocity check. For any market you are currently evaluating or currently holding a position in, what has happened to transaction volume over the past 4 to 8 quarters relative to the historical norm for that market? A market where volume has declined more than 30% from its pre-pandemic historical average is a market where the apparent stability of prices is being supported by transaction suppression rather than active price discovery. That distinction matters enormously for understanding the risk of your position. The second recalibration is the income replacement audit. What is the primary employment sector in your market, and what is the current trajectory of that sector relative to the long-term structural forces affecting it? This is not a question that current employment data answers. It is a question that sector analysis, productivity data, and the investment decisions of the major employers in that sector answer. A market whose primary employer base is investing heavily in automation, consolidating facilities, or reducing headcount in functions that its workforce is concentrated in is a market where the income replacement trajectory risk is building regardless of what the current unemployment rate shows. Here is the final analytical framework that separates markets that look safe from markets that actually are safe in the current cycle. Ask 3 questions of any market you are evaluating. First, is the transaction volume supporting current prices the result of active buyer competition or of lock-in suppressed supply meeting insufficient demand? Second, is the employment income that created the current price level being generated by a sector with durable forward demand or by a sector whose structural trajectory implies income compression? Third, are the carrying costs of ownership, including taxes, insurance, and maintenance, rising faster than the income growth of the potential buyer pool that would need to absorb your property at current valuations if you needed to exit? If the honest answers to those 3 questions raise more concerns than they resolve, the market looks safer than it is. This is exactly why it matters. The data that reveals structural risk is public. The mistake is not looking for it because the surface says everything is fine. The closing, what the current cycle is actually telling you. Every correction cycle in U.S. housing history has been preceded by a period in which the markets that subsequently corrected most severely were described as stable, safe, and fundamentally sound. The description was accurate on the surface. It was inaccurate at the structural level. And the gap between the surface description and the structural reality was the defining characteristic of the period that preceded the correction. The current cycle has produced a specific version of this pattern. The markets that have already corrected, the Sun Belt cities that overbuilt and overappreciated and are now visibly adjusting, have absorbed the national narrative about housing market risk. The markets that look safe by contrast, the Midwest suburbs, the secondary Sun Belt markets, the Northeast commuter corridors, Nashville, are carrying structural risk that their surface stability is actively concealing. The homeowners and investors in these markets are not making irrational decisions. They are making decisions based on the information that the standard market analysis framework provides. That framework is telling them their markets are fine. The structural indicators, when they are examined, are telling a more complicated story. The gap between those 2 readings is the most important analytical question in U.S. housing right now. Recognizing that gap does not require predicting the timing of a correction. It requires understanding that stability and safety are not the same condition, that surface indicators and structural indicators can diverge significantly before that divergence becomes visible in price data, and that the cost of identifying the divergence before it materializes is a few hours of deeper analysis, while the cost of ignoring it can be measured in years of equity erosion. Here is the final convergence of everything this breakdown has established. The markets that look safe but are not in the current cycle are not hiding their structural risk. They are displaying it in data that is publicly available, analytically accessible, and systematically being overlooked because the surface indicators provide no reason to look deeper. The homeowners and investors who examine the structural indicators honestly, who ask the three questions this framework provides of every market they are exposed to, and who calibrate their liquidity and positioning accordingly are the ones who will look back on the current cycle as the period when they made the right analytical call. The ones who relied on the surface stability narrative will discover what every previous correction cycle has confirmed: that the most dangerous market is always the one that looked safe until it did not. The surface says stable. The structure says something else. The question is which one you are listening to.